The global trade war escalating. President Trump announcing 25% tariffs on cars and car parts not made in America, and threatening more tariffs on the EU and Canada if they work together against the U.S. Markets weighing the potential impact to the U.S. and the global economy off the back of these tariff announcements. Joining us with more, AJ Rajadesk. He's Barclays Global Chairman of Research. AJ, great to have you on here. Talk to me about how the market is digesting these latest rounds of tariff announcements. Do you think the market is ignoring a bigger risk come April 2nd?
Yes. And you're absolutely right. The market so far has been far more sanguine than we expected, even after the pullback in equities that we got in the first quarter, and especially overnight. I mean, the Mexican peso has really not moved very much. 5% of Mexican GDP is finished autos exported to the United States. If there's an actual 25% tariff going on that, maybe it gets taken out. But right now, that's what the president says, and the market does not seem to be reacting to it at all. And I'm not quite sure why. Maybe it is that the market thinks that this is the worst of it, that the reciprocal tariffs will be a nothing burger. Remember, the president did say that he was not going to impose reciprocal tariffs that necessarily included all non-tariff measures. So, that's the difference, Madison, between 2% and 20% tariffs on April 2nd. But yes, right now the market is very sanguine.
So what do you think investors should be doing right now? What would make more sense to you on the tape?
Be as defensive as possible, honestly. I know this is not a great message to have, but we have pulled back in equities, but we've only pulled back about 6 to 7% on the S&P 500. As you mentioned earlier in your forecast, we have a 5,900 call on the S&P. That is in our baseline. But our baseline does not assume the worst case on tariffs. If you get a worst case, you do get a US recession. And then our bear case is 4,400 on the S&P. That's a long ways to go lower. So we are as defensive as I can remember in the last 2.5 years. That's what we are telling clients.
Yeah, AJ, you mentioned defensive maneuvers. That sort of makes sense. A lot of us on the street are struggling to find where we can find some shelter in this market. I'd be curious to know what your thoughts are. Where we should be looking for that defense at this point, taking money off the table or what have you.
So financials we like, including in the US, but also in the euro area, even now. I mean, I know European financials had a great 2024, but I think there's still room to go. We like healthcare in the United States. We generally think the big 6 tech firms are going to have pretty good earnings. The earnings are going to hold up. They are much cheaper. If you remember, they were trading at a 31, 32, 12-month forward multiple. They are now running at closer to 25, and they're starting to get interesting. But the S&P 493, at an 18 multiple for 12-month forward earnings still looks too expensive. Europe's catch-up, we think, is largely done. China tech, we think, still might have a little more bit of room to run. But yeah, you're starting to run out of places to hide. For a while, I think it's going to be cash and front-end US rates.
Thank you for that. Jay, final minute. Can you tell me a little bit, you mentioned healthcare. Within the healthcare sector, it's a very broad sector. Which areas within the healthcare sector would you look at right now? Because it's so different from one end to the other.
So, what we are telling investors is to stay away from sectors that have not overreacted to the RFK nomination and confirmation. But there's a bunch of sectors within healthcare that have. We don't think there's actual policy changes on that front that are going to be that aggressive. But more importantly, it does tend to be one of the sectors. Even if you go into a pullback in consumption, you don't get a big pushback on pulling back on spending on that front. And even that, you said it's a big sector, it is a big sector, but overall we still think that sector as a whole is going to be fine.
At what point, AJ, does the totality of the uncertainty and some of the softness we're seeing in the economic data make you call for a recession?
The thing to watch is the US savings rate. That is the Achilles heel for the US economy. It is extraordinarily low. It's been low for the last 3.5 years. For context, it's between 4 to 4.5% now. 2019, the last full year before COVID, when the jobless rate was lower than it is right now, the savings rate averaged 7%. Now, if you get a steady drumbeat of policy uncertainty, though job cuts, actual tariffs, the equity markets pulling back, it's not crazy for that to go from 4.5 to say 6.5. But 70% of the economy is consumption. If the savings rate goes up 2 points, consumption pulls back 2 points. That's 150 basis points of growth gone like that. That I think is the thing that we don't think it comes to that. We think we will avoid a recession. Josh was on my call, a little earlier when he was talking to Venu. So that is the call. But the risks are tilted to the downside if April 2nd ends up being worse than expected.